Are you interested in learning how to invest in stocks in 2023? If so, you're in the right place. Investing in stocks can be a great way to grow your wealth over time, but it's important to go about it in a smart and informed way. In this video, I'll be sharing with you some key tips and strategies for investing in stocks in 2023. First things first, what are stocks? Stocks, also known as equities, are a type of investment that represents ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. As the company grows and becomes more successful, the value of your stock may also increase, resulting in a potential profit for you. So, how do you go about investing in stocks? Here are some steps to consider. 1. Start by setting clear financial goals. Before you start investing in stocks, it's important to know what you're trying to achieve. Do you want to save for retirement, fund your child's education, or simply grow your wealth over time? Knowing your financial goals will help guide your investment decisions and ensure that you're making choices that align with your overall financial plan. It can be helpful to create a written financial plan that outlines your specific goals, the steps you'll take to achieve them, and a timeline for doing so. This can help you stay focused and on track and make it easier to track your progress. 2. Develop a diversified portfolio. Diversification is a key principle of investing, and it refers to the idea of spreading your investments across a variety of different asset classes and industries. This can help mitigate risk and increase your chances of success. For example, rather than putting all of your money into one company's stock, you might invest in a variety of different stocks from different sectors, such as technology, healthcare, and finance. It's also important to not only spread your investments across different asset classes and industries, but also to consider factors such as company size and location. For example, you might want to include both large, established companies and smaller, up-and-coming ones in your portfolio. Diversifying globally can also be beneficial, as it allows you to take advantage of growth opportunities in different regions of the world. 3. Consider using a financial advisor or robo-advisor. If you're new to investing or feeling overwhelmed by the process, you might consider seeking out the help of a financial advisor or using a robo-advisor. A financial advisor is a professional who can help you develop a customized investment plan based on your financial goals and risk tolerance. It's important to look for someone who is certified and has relevant experience in the field, and it can also be helpful to work with someone who has a fiduciary duty, which means that they are required to put your interests above their own. A robo-advisor is an online platform that uses algorithms to create and manage an investment portfolio for you based on your specific needs. Both options can be helpful for beginners who are looking for guidance and support, but it's important to carefully review the fees and investment options offered by different platforms. 4. Learn about the different types of stocks. There are several different types of stocks that you can invest in, including common stock, preferred stock, and exchange-traded funds, ETFs. Common stock represents ownership in a company and entitles the holder to a share of the company's profits and voting rights. Preferred stock is similar to common stock, but it typically has a fixed dividend and may not come with voting rights. Preferred stock often has a higher claim on a company's assets and earnings than common stock. ETFs are a type of investment that tracks the performance of a specific group of stocks or bonds. Understanding the differences between these types of stocks can help you make informed investment decisions. 5. Research companies before investing. It's essential to do your due diligence before investing in a particular stock. This includes thoroughly analyzing the company's financial health, management team, and competitive landscape. This can be done by reading the company's financial statements, which can be found on their website or through the Securities and Exchange Commission's (SEC) EDGAR database. Financial statements provide a wealth of information about a company's financial performance, including its revenue, expenses, profits, and debts. Additionally, you can read news articles and analyst reports to get a better understanding of the company's performance and future prospects. It's also helpful to compare the company's financials and business model to those of its competitors to see how it stacks up and to identify any potential risks or opportunities. 6. Monitor and review your investments regularly. Investing in stocks is not a one-time event, it's an ongoing process. To ensure that your portfolio is aligned with your financial goals and that you're on track to achieve them, it's important to periodically review your investments. This includes checking the performance of individual stocks and making any necessary adjustments, such as selling or reallocating investments. It's also essential to keep an eye on the overall market and economic conditions, as these can have a significant impact on the performance of your investments. Market conditions can change quickly, so it's important to stay informed and be prepared to make adjustments to your portfolio if necessary. 7. Consider using a stop-loss order. A stop-loss order is a type of order that automatically sells a stock if it falls below a predetermined price. This can be a useful tool if you're concerned about a particular stock losing value and want to protect yourself from potential losses. By setting a stop-loss order, you can ensure that you don't hold on to a stock for too long if it's not performing as expected. Stop-loss orders can be particularly helpful in volatile markets, as they allow you to set a maximum price at which you're willing to sell a stock. 8. Use dollar-cost averaging. Dollar-cost averaging is a strategy that involves investing a fixed amount of money on a regular basis, rather than investing a lump sum all at once. This approach can be helpful for beginners who may not have a lot of money to invest upfront, as it allows them to gradually build their portfolio over time. Dollar-cost averaging can also help mitigate risk, as it allows you to buy stocks at different prices rather than all at once. This means that if the market is fluctuating, you'll be able to buy more shares when prices are low and fewer shares when prices are high, which can help even out the overall cost of your investments. 9. Keep an emergency fund. It's important to have an emergency fund in place to cover unexpected expenses or financial setbacks. This fund should be separate from your investment portfolio and should only be used for emergencies. Having an emergency fund can help prevent you from having to sell your investments at a loss in the event of an unexpected event. Ideally, your emergency fund should have enough money to cover at least 3 to 6 months' worth of living expenses. This will give you a cushion to fall back on in case of an emergency, such as a job loss or unexpected medical bills. It's also a good idea to periodically review your emergency fund to make sure it's sufficient for your needs and to make any necessary adjustments. 10. Understand the risks involved. It's important to remember that investing in stocks carries some level of risk. The value of your investments can go up or down depending on a variety of factors, including market conditions, company performance, and global economic events. While there is the potential for significant returns, there is also the possibility of losing money. It's important to be aware of these risks and to invest only what you can afford to lose. Some common risks to consider include market risk, which refers to the possibility that the overall stock market will decline, industry risk, which refers to the possibility that a specific industry or sector will underperform, and company-specific risk, which refers to the possibility that a specific company will perform poorly. Diversification can help mitigate some of these risks, but it's important to remember that no investment is completely risk-free. 11. Keep an eye on fees. When you invest in stocks, you may be charged various fees, such as trading fees, management fees, and advisory fees. These fees can add up over time, so it's important to be mindful of them and to choose investment options that are cost-effective. Trading fees are charged every time you buy or sell a stock, and they can vary widely depending on the broker or platform you use. Management fees are charged by investment managers for the work they do in managing your investments, and advisory fees are charged by financial advisors for their guidance and support. It's important to carefully review the fees associated with any investment option and to choose options that are cost-effective. 12. Stay informed. Finally, it's important to stay informed about the markets and the companies you're investing in by regularly monitoring your investments and staying up to date on news and events that could potentially impact their performance. This can help you make informed decisions about when to buy or sell stocks, and it can also help you spot potential opportunities or risks. It's also important to stay informed about broader economic and market trends and understand how they may affect your investments. There are several different ways you can invest in stocks, including through a brokerage account, a retirement account, or a mutual fund. A brokerage account is a type of investment account that allows you to buy and sell stocks and other securities. A retirement account, such as a 401k or IRA, is a type of account designed specifically for saving for retirement. A mutual fund is a type of investment that pools together money from many different investors and uses that money to buy a diverse range of stocks, bonds, and other securities. When choosing which type of account to use for your stock investments, it's important to consider your financial goals and risk tolerance. For example, if you're saving for retirement and have a longer time horizon, you might be more comfortable with a higher level of risk in your investments. On the other hand, if you're saving for a shorter-term goal, such as a down payment on a house, you might want to be more conservative with your investments. Another thing to consider when investing in stocks is the concept of asset allocation. Asset allocation refers to the way you divide your investments among different asset classes, such as stocks, bonds, and cash. The right asset allocation for you will depend on your financial goals, risk tolerance, and investment time horizon. A financial advisor can help you determine an appropriate asset allocation for your specific situation. Finally, I can say that investing in stocks can be a great way to grow your wealth over time, but it's important to go about it in a smart and informed way. By setting clear financial goals, developing a diversified portfolio, seeking out the help of a financial advisor or robo-advisor, understanding the different types of stocks and the risks involved, keeping an eye on fees, and staying informed, you can increase your chances of success in the stock market. There are many different factors to consider when it comes to investing in stocks, and it can be helpful to seek out the guidance of a financial professional if you're feeling uncertain or overwhelmed. Whether you're a seasoned investor or just starting out, it's important to be proactive and to take the time to research and understand the various options available to you. With careful planning and due diligence, you can make informed investment decisions that align with your financial goals and help you build a solid foundation for your financial future. I hope these tips have been helpful, and I wish you the best of luck in your investment journey. If you enjoyed the video you just watched, be sure to hit the subscribe button and join our community of like-minded individuals seeking financial advice, investment strategies, and much more. By subscribing, you'll have access to a wealth of information and insights that will help you make informed decisions about your financial future. In addition, be sure to hit the like button and share the video with your friends and family. Sharing is a great way to spread the word about our channel and help others benefit from the valuable content we offer. We look forward to continuing to provide you with top-quality financial advice and guidance in the future, so don't miss out. Subscribe now.